Hi, this is Palmer, coming to you from optionspreadtrades.com. I got another trade for you today. We're going to buy a Strangle on Nokia, that's NOK, because earnings are coming up on October 16th. That's next week. Today is October 9th. So what we're going to do is we're going to purchase a January 2009 put option with a strike price of $16. Then we're going to purchase a January 2009 call option with a strike price of $17.50. We're going to set a limit order of $3.50 and a stop loss of 25%. Now we're going to hold until after the announcement's been made on the 16th. And if it gaps in the direction of the trend, we can try to hold on for more profits. It is taking a little bit of a risk. The probabilities are in your favor, though. We're going to use no more than 2% risk on this, and we're only going to keep the trade, set the limit order until the 14th. If it doesn't hit, we're going to go ahead and cancel it. Now let's take a look at why we're doing this trade. As you can see here, we've got the earnings announcement coming up for Nokia. It's on the 16th of October. So let's take a look at the past few earnings announcements and see what they did. Okay, so we've got July 17th, April 17th, and January 24th. Okay, so remember those dates. So July 17th, we had a small gap here. Okay, it was only a small gap of about $2. So that's less than 10%. It's probably about 7%, 6-7%. Now we're usually looking for about a 10% gap, but let's go back to April 17th. Here we've got April 17th. From the 16th, it opened at around 33.22. I don't know, it closed at around probably, what is that, about 33. And then the next day, it opened at 29.59. So that is a gap of about almost $3.50. It's about $3.50. So that's more than 10% gap, which is exactly what we're looking for. Okay, then we're going to go back to, what was that date? January 23rd, I believe. January 24th, okay? So if we're looking from the 23rd, that had a high, it closed at about 32.73, and then the next day, it opened at 35, so that's what, about $2.25. $2.25, okay, which is still, it's a little bit less than the 10% gap that we're looking for. That's probably what, about, I don't know, 6-7% again. But given the volatility in the markets lately, we're going to take this, probably, it's a low risk, high probability trade. We're in and out in about a week. We're going to go ahead and take a look at the options chain here. Okay, so the options chain, we're looking at January. The reason we're looking at January and not November is because January gives us quite a bit of time. We can hold a few weeks later or a few weeks longer if we want to. Now the bid price is $1.85 for the put, and it's $1.80 for the call. So we're going to set our limit order to about a little bit under that, at around $3.50. $1.85 plus $1.80 is $3.65. So we're going to try for about $3.50. Again, if it doesn't hit, we're just going to cancel out the trade and let this one go. If you want to see more trades like this, please come visit us at optionspreadtrades.com, and we're going to go ahead and update this trade after it's hit. Okay, have a great day and happy trading.